My name is Martin Dodd from Midlands Investment Agency. I'm a financial advisor based in Wolverhampton. Today I'd like to talk to you one of my very favourite subjects, which is about investing, and specifically the 7 deadly sins of investing, as I call it. The first sin, in my opinion, is people following the latest fashion or trends in investing. Probably one of the most recently memorable trends that occurred in investing was the dot-com boom. Many, and if not millions, of investors piled substantial amounts of money into technology companies 10 or more years ago, and many of these companies never actually made any kind of a profit, and the vast majority of these companies eventually went out of business. But many people invested fortunes into these companies because they believed the hype that they were going to make a fortune, a killing if you like. But sadly, following the latest fashions in investments can lead you to a position where you lose substantial amounts of money. So that's our first major sin of investing. The second biggest mistake that investors often make if they are investing on their own behalf is that they think they are city traders, or they think they have enough knowledge to be able to behave and invest like a city trader. The reality is that many city traders themselves are not particularly profitable. So I would suggest that lay people that have other businesses and other jobs are even less likely to be able to succeed operating like a city trader. What I mean by a city trader is trying to time the market, trying to buy into individual shares and trade in those shares in perhaps a trading range. The problem with this type of trading activity is that nobody really knows where the bottom of the market is, nobody really knows where the top of the market is. So it's incredibly difficult to trade on a day-by-day basis in individual shares. Very tempting, but it's incredibly difficult. So our second deadly sin is stop thinking that you're a city trader. The third deadly sin of investing is not knowing what you're paying in fees. Very often investors look at the headline returns that they are able to or can achieve from an investment, but they don't really know what fees they're paying. Clearly nobody will offer you an investment that comes without any costs, but on the other hand you also really need to know what fees you are paying, because if that affects the returns substantially, then it's obviously going to affect the underlying value of your investment. So our third deadly sin is know what fees you're paying. The fourth deadly sin that people often make with investments is they buy an investment of some kind and just leave it. There's nothing wrong with holding an investment long term, but what is very important is that you keep it under review and know how it's performing. One of the major reasons that you want to know how your investments are performing is that you need to be able to make an adjustment to your portfolio if it starts to underperform, and the only way that you're going to be able to identify whether your investments are performing is by keeping them under a regular review. So our fourth deadly sin is failure to keep your investments under constant review. The fifth deadly sin of investing is failure to build a diverse portfolio. Often people will buy 1 or 2 investments within their pension portfolio or their investment portfolio, perhaps just 2 funds. The major problem with investing in that way is that if you've only got 1 or 2 investments in your portfolio and that particular investment happens to be an investment that doesn't perform, either all of your investment portfolio or at least half of it will underperform. That would therefore mean that the other part of your portfolio has got to work extremely hard for the overall return to be the right return that you want. So our fifth sin of investing is failure to build a broad-ranging portfolio. The sixth deadly sin of investing is the failure to diversify the types of investment in your portfolio. It's very similar to broadening the different investments in a portfolio, but it's subtly different in that it's important to build a portfolio that has different asset classes. For example, you wouldn't necessarily want to own just stocks and share type investments in your portfolio. You might want to include within that fixed interest investments, potentially property investments if they're profitable at the current time, and cash investments as well. So our sixth sin of investing is failure to diversify your portfolio. And the seventh deadly sin, and this is by far and away the biggest sin that many people make, and that is failure to invest at all. Clearly, if we want to achieve financial security for ourselves and our family, we have to put some money aside for investing. So our seventh deadly sin, and I will repeat, the biggest of all, is failure to invest at all. My name is Martin Dodd. I'm a financial advisor at Midlands Investment Agency,